So we are going to begin now with the second session of the workshop. But in fact, now we begin formally the workshop by first presenting ourselves, what we are doing. I mean, I will ask everybody to present a bit and the relation with the work on FDI. But before going to there, I'd like to mention what, as I already mentioned before, what is our objective of this workshop. Our objective of the workshop is basically to first to understand the latest international standards in terms of collecting FDI statistics. Although FDI statistics, it seems at the first as if very easy as a concept, is very difficult to collect the data according to the latest international accepted standards. So the first one is we would like you at the end of the workshop. So the idea is that while at the beginning of workshop there is no problem if you don't know the definition of FDI, there is a big problem if you don't know at the end of it. The second one is that in addition to the concept and definition, our objective is to initiate a networking between all the stakeholders and the regional representatives, the country representative of GCC, to initiate a networking among all people that are involved in collecting FDI statistics in order to look for future, what is our, in order to improve FDI statistics for the GCC region and to see several steps how to improve it with the final aim of preparing a GCC investment report. Today in the morning we present a World Investment Report. Once again, I hope that 3 years from now we are going to be here again, present the GCC investment report. But the GCC investment report is not going to be prepared by UNCTAD. It's going to be prepared by all GCC members and with the assistance of UNCTAD. That's the goal. This is the goal of the workshop, which is the beginning of a series of workshops and initiatives in order to have a better harmonization of the data among GCC countries. So with that, let me begin by myself. I am in charge of data and trend section in UNCTAD, working with Mr. Fujita and working as a part of a team of World Investment Report, but we are working as well or providing technical assistance with other countries in improving FDI statistics, different regions in ASEAN, in Latin America, in transition economies in Africa, in order to improve the FDI data. And we report this data either in World Investment Report or in bilateral FDI statistics on FDI by industry. So all the data that we are reporting. That's my work. So please let me begin by.
Thank you very much. My name is Adil Saleh Ahmed Basra. I work as an economist at the Ministry of Finance.
My name is Abdurrahman Al-Awadi. I am ex-Ministry of Finance staff. Retired from Ministry of Finance.
My name is Osama Al-Ababna. I'm working at National Bureau of Statistics in United Arab Emirates. I'm an expert assistant. My work is as a project manager for the Foreign Investment Survey.
Excellent, very good, thank you.
My name is Dr. Matar Ahmed. I am from Ministry of Economy. My job title is Director of Analysis and Trade and Industry Information and Research.
My name is Abhishek Gupta. I'm currently working with Central Bank of the UAE and I'm working as an assistant economist with the statistical department. Central Bank of the UAE. Yeah.
My name is Jamal Al-Zayar, Associate Professor from the University of Ahliya. I'm in the area of decision science, statistics and operation management.
Ahmed Al-Haiki, faculty member at Banking and Finance at Ahliya University.
Good afternoon to you all. My name is Jafar Al-Uraibi, Bahrain Chamber of Commerce and Industry. I am Senior Economist, Economic Research Department. Thank you.
And my name is Amir Robey. I teach economics at the university.
Abdullah Bakr. I'm working as a consultant to MENA.
My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MENA. My name is Abdullah Bakr. I'm working as a consultant to MEN
My name is Fawad. I'm working as an auditor for Mises Chartered Accountants.
Hi, my name is Ricky Gomez. I'm working for Central Informatics Organization of Bahrain.
My name is Adil Muhammad. I'm teaching accounting. My job title, Director of MBA Program at Ahliya University.
My name is Jamila Al-Mahari. I teach at the University of Bahrain, teach mainly courses in entrepreneurship.
My name is Yasmin Badr. I'm a student at Ahliya University and majoring in economics and finance.
Reem Janahi, student at Ahliya University, majoring in economics and finance.
Hello everyone, my name is Huriya Hafid. I teach finance, risk management and principles to finance in Ahliya University.
Assalamu alaikum. Nasima Debba from Ahliya University, Department of Banking and Finance.
This is Iman As-Samak. I'm a senior labor market researcher at LMRA, Labor Market Regulatory Authority.
My name is Dana Abdullah. I'm an officer at the Economic Development Board, specifically in the Economic Planning and Development Department.
Hi, my name is Dana Al-Majid and I'm with the Labor Markets Regulatory Authority and I work with the Market Intelligence Department.
Hi, my name is Munir Al-Sarawi from Kuwait Central Bank. I'm in Economic Research Department, Statistical and Translation section.
Yeah. So we have the representative from Kuwait. I don't know, we lost the representative of Saudi Arabia. Maybe he's coming, yeah, please, that's true. Then we have a representative from United Arab Emirates. And then, yeah, I think that's, we don't have, where is Hannah? Maybe, can you ask Hannah? There is no representative from the Central Bank of Bahrain? Okay, so I think that we can begin. So how we are going to begin to proceed? We are Mr. Fujita is going to make a presentation for the needs of reliable data, FDI data, and then I will discuss later with again FDI as a part of balance of payments, then FDI flows, FDI stock, and FDI income. How much that we can get till the end of today's seminar, and then we will continue tomorrow. Okay, so thank you.
Thank you, Astrid. Perhaps later on, so we get much closer because a bit far on the two ends. So maybe so we remove one desk and then get closer. So next the coffee break, I hope. Now, once you now understand what we want to do during the next 3 days, and we already started. And now he said it's beginnings of the workshop in the sense that you learn the concepts, methodologies, which underline the balance of payment, which underline the FDI, as defined in the balance of payment. But first of all, here, if you look at the material 3, why we have to look at the FDI data. Now, FDI data, of course, is one of the many economic variables. So just if you look at even international transaction, you have the exports, or you have the bank loans, for example. You have the portfolio investment, not necessarily FDI. There are a lot of international transaction variables. In the domestic market, you have the GDP, so you have the consumption, you have many economic variables. FDI as one of economic variables, similar to the other data. Actually, we have to, of course, want to produce quality data. Now, then when we judge how good, how bad the data are, perhaps we can see these criteria. You see there? Comparability, usefulness, reliabilities, availabilities, and timeliness. These 5 I would say, basic element to any kind of data. If any of them lacks, then I don't call you have a quality data. Then the questions whether we need all of these 5 criteria for FDI data. If not, we have to amend in order to have. Now first, let's pick up the criteria on the comparability. As I mentioned to you, actually data should be comparable. Comparable to the other countries' FDI. And now, here we pick up your countries. You see Oman, Qatar, Saudi Arabia, Turkey, which is not necessarily GCC, but it's in the MENA country, MENA region, and the UAE. There are 5 countries as examples. You see the countries? And for each country, you have 2 columns. Now, when you have investment in Bahrain, for example, there is investment from Saudi Arabia in Bahrain, then this particular investment you can look at from Bahrain's point of view, and also you can look at from the investor's point of view, in this case Saudi Arabia. If you look at their one particular deal, this deal, no matter where you look at, should be the same. So therefore, in FDI data, FDI statistics, what you report should be also reported by the other. Now, I don't know whether you can see, but you have maybe a handout so you can see. Now, for these 5 countries, here on this column, you will see the investors. Let's, for example, let's pick up like which country is good? Maybe United States. We take not necessarily United States. Which country we take? Japan. We take Japan. We take Japan. Now, Japan is investor in your countries. How much almost got from Japan? It's almost nothing. But if you look at the Qatar and also look at the Saudi Arabia, you have numbers. At least, Qatar or Saudi Arabia reports how much they get from Japan. For example, here in Qatar, as reported by Qatar, you see it from Japan, how much they get? How much they get? $433 million. This is what Qatar reports. But in the same year, Japan says how much they said they invested in Qatar. 63. Saudi Arabia, how much reported by Saudi Arabia? Not even negative. It's capital withdrawals. So there are some kind of divestment may have taken place. Minus 54, but Japan said positive investment 100. Since we are looking at investment, no matter where you look at, the value should be equal. Of course, it cannot be 100% equal, but it should be close to each other. Because depending on when you record, maybe exchange rate is different because exchange rate changes every minute even. So depending on timing, some difference may appear, but not so much different as we see here. And you look at for the United States at the end. United States, Saudi Arabia reports $4,127 million in investment in the United States. But the US says minus $66 million. If you look at the UAE, the last columns, again, some differences. While UAE reports you have investment $3 billion, well, $3,108 million from the United States, but the United States $2,000 millions differences. What is the problem? I think this is beyond the change in the exchange rate, depending on when you record it. It may be related to the different methodology. So that is why, if all of you so keep the same methodology in recording, then we don't expect to have so huge differences as reported by a recipient or as reported by the investing countries. Now, I picked up 5 countries here, but this kind of the differences we see everywhere, even developed countries. So therefore, so once you understand what the FDI is, you're going to understand in the next several sessions of this workshop. If you understand how the data is compiled, then this kind of problem hopefully is resolved. Okay, and if there is imbalance between recipient countries and investing countries, even though we look at the same project, there's some differences in the value. If you aggregate the world level, what's going to happen? Like exports, imports, exports should be imports for the others. Therefore, normally exports, imports should balance. Of course, it depends on how their values is measured. Like in the case of export, normally CIF plus cost insurance freight is included. No, that's for FOB. CIF price for the imports, and exports normally free on-board price. So of course, depending on the prices, some differences, but so not so much big difference between exports and imports. But in the case of FDI, when you aggregate, inflows and outflows do not necessarily balance, do not necessarily match. That is what we are looking at here. Green lines is FDI inflows, and the blue, green, and the red ones FDI outflows. And the differences is in the blue. There are some big differences, particularly like 2000 and mid-2000, 2005, 2006, 2007. Sometimes inflows exceed outflows. The other times, maybe outflows exceed inflows. In any event, do not balance out each other. Particularly 2000 and mid-2005, huge differences between inflows and outflows. So there must be something wrong in collecting FDI data. Well, actually, the FDI's data, particularly when it is undertaken through merchant acquisition, sometimes it's quite difficult, even for data compilers, how they compile FDI. Merchant acquisitions, of course, which is to acquire the existing assets, existing companies, while the greenfield is a new investment. Therefore, normally, when you talk about the FDI, there are 2 different modes. One mode is the mandates, acquisition of existing assets. The other is greenfield investment, which is new investment. Particularly M&As, when foreign companies acquire assets, acquired companies here, for example, how they record between host countries and investors may be different. Particularly nowadays, if you look at M&As, sometimes very big M&As undertaken, like 10 billion, 20 billion, 30 billion, sometimes even $100 billion. So far, the largest M&A is more than $100 billion, one case, which is the deals by Vodafone to acquire management in Germany. I think the 2000. That's why in 2000, if you look at the FDI flows, if you go back to the first presentation, you saw the FDI trends over the past 20 years or so. 2000 is a peak, again 2007 is a peak. All these peaks, actually behind these peaks, M&A played a very big, important role. If you have one deal just $100 billion, it's 100 times more than your balance gets every year. This is just an example, but many other examples, like a $40 billion investment, M&As, by Mercedes to acquire Chrysler of the United States, which is again, as you know, merged but demerged. You know the histories of this. All these big deals, M&As, you know how they do this? They can't buy in the cash, simply. They can't buy cash with cash. Because who has $100 billion in cash or $14 billion in cash? No one. What they do, therefore, they use their own shares and exchange the shares with others. Exchange of shares. This is how their M&As took place.
I wanted to ask, do you have a specific criteria or what is really foreign direct investment? A loan from a World Bank, is it a foreign government of Qatar buying real estate in Paris? Is that a foreign direct investment? What criteria do you use to define exactly that this number is an FDI?
Well, actually, this is what you're going to learn after these presentations. Because we are dealing with the concept of the FDI. But to answer you so quickly, actually, the FDI should be long-term investment, as you know, and normally statistically defined as an investment which acquire more than 10% shares of the other companies.
But when Qatar buy Harold in London, is that FDI?
Actually, the real estate acquisition, that's also the investment, FDI. I know in the real estate investment may not be, as someone mentioned, not productive. It may be only speculative. But it's defined as FDI. But these things we learned in details after this. What is FDI and so on. But here's as introductions to the methodology. I want you to understand what kind of problems you are facing in FDI. Once you understand what the problems we face, then the next stage for you to how to collect them. In order to collect them, you have to understand the methodology. So that is a sequence, and perhaps as you wait a little bit more. But yes, real estate investment is investment, therefore Harrods, investment to acquire Harrods, that's also investment. Actually, if you look at the capital accounts in advance payment, there are three different components. Actually, one is FDI, portfolio, and the other investment. The one you mentioned, someone bought the monies from a foreign bank to invest here, for example. Suppose you want to run a company, you need the money, but you happen to borrow the money from a British bank, for example, and use it. In this case, it's not FDI, because you and the bank which lend you, there's no relationship. Bank is not your parent's company. Simply the bank is to provide loans to you. In this case, this loan is recorded in the other investment. Other investment, one of three investment. FDI, greenfield, also FDI, portfolio, and other investment. So loans is different.
Productive sector? It has to be a productive sector? This is what you want to say?
Was economically supposed to be, but statistically, it may not be such a case because in the statistics, when you collect data, you can judge, you can introduce element whether this is really productive investment or not. If you have an investment from somewhere, and if the foreign company acquires more than 10% of your assets, equity, we consider automatically FDI. Even if maybe foreign company are not interested at all in running a company. But still, on the other hand, if foreign companies invest in you, but less than 10%, therefore it is not FDI in the statistics, it's only recorded under the portfolio investment. But that foreign company may influence your company, may influence your management. That's also possible. But in statistics, we disregard. Because if we include this such a subjective element, actually, we cannot collect the data. So that's why statistically, we clearly define what the FDI is or not.
He's a Saudi buying a house in Bahrain. Is that FDI? He's from Saudi Arabia, and he bought a house in Bahrain. Is this money that he brought is FDI?
In this case, he's Saudi Arabian. He bought a house in Bahrain. This is FDI. Actually, you learn later when you look at the FDI. I mean, we mentioned the way of the investment, which is greenfield and M&A. There's other, how do you say, the types of investment when you look at by type of the establishment, how the foreign companies come into the business. There are three essential types. Like one is what they call the established subsidiaries, which more than normally 50% owned by foreign companies. And also associates, which is normally owned by 10 to 49%. Should be more than 10%, yeah? Otherwise it's not called the FDI. And this associate, and the other type we call branches. Branches, when you hear the branch, you may tend to think like banks branches and so on. But such investment in like real estate, buying a house, here is considered actually included in the element of the branches. So yes, real estate investment is FDI. I know it's only for your purpose. You are not interested in maybe making money. Of course, you may be because you may want to sell it later. But normally, we don't consider such a productive investment as real estate. Yes, that's what happens. That's also in this case, it's capital withdrawals. In this case, FDI, you have the FDI stock already in your country, then this amount is deducted from the stock. because it's no longer owned by Saudi Arabia.
Excuse me, I'm a little bit confused. How you define FDI from business perspective? Okay, please.
Was I said the economic definitions may be different from statistical definitions. Statistical definition, we should be clear-cut on how we define FDI. Otherwise, you cannot capture, you cannot calculate, you cannot put the things in number. In the economics, for example, FDI, first of all, FDI is long-term. Long-term is normally dependent on how long the other party, in this case, foreigners, keep. Normally it's 1 year's judgment. More than 1 year, it's long-term. Less than 1 year, short-term. Long-term. The others is direct. Direct invest direct in a way to influence the management directly. Long terms and the management influence. If you have these two elements, normally the relationship between investors and you should be much closer. It's kind of between parents and daughters or sons, like it's kind of family. So that's why we sometimes call investing company it's parent companies. And for the parent companies, you are subsidiary or you are the daughter companies and so on. So, but this is economics meaning. I mean, therefore, investment which is not necessary, which is not used for the production, then we should not call FDI. We should not call FDI. But in statistics, as I mentioned to you, everything which is more than 10% acquisition, automatic FDI, even if it's not for the purpose of the production, still FDI. Therefore, some differences between economic meanings and the statistical meaning.
Why it should be above 10%? What if it's 9 but worth billions?
Well, that's a very legitimate question. Why not the 20? Why not the 5? Well, actually, it is quite interesting. I don't know either. But at least my experience will tell you, perhaps some of you may know, particularly those who work for the central bank, that we produced a new manual, advance payment manual, 6th edition. Perhaps that you know it. And all the items in the advance payment clearly defined. FDI same thing, still more than 10% from acquisition is criteria. At the time we discussed the definition of FDI. Some people say, why 10%? We should change to 20%, for example. There's some reason why particularly European countries want to change from 10 to 20%, simply because when you, maybe as an accounting professor, when you consolidate the companies, what criteria you use. In the case of EU, more than 20% owned by parents should be consolidated. So therefore, it's easier also for them to use 20% as criteria, threshold, either investment or FDI or not. That proposed once. But we have kept 10% criteria simply because it's a long story, a long history already. Because 10% from the beginning, already 30, 40 years, definition of FDI is more than 10%. And if it is arbitrary from the beginning, 10% should be arbitrary, I think. Arbitrary set 10%. So therefore, we still continue to use 10%, not change the others and confuse the other people, because they are, still many countries, particularly developing countries, as you may know, do not collect FDI data accurately in accordance with international standards. Therefore, so we stopped. We gave up the changing or definition of FDI. Therefore, they have kept 10%. Therefore, I think, as was happened when we discussed from 10 to 20%, 10% was arbitrary set. Okay. So when FDIs is not balanced at the bilateral level, obviously at the aggregate level, not balanced either. The other reason why data are not comparable is perhaps how you evaluate the numbers. When you, perhaps if you know the accountant, or if you know the accounting, then you know how you measure your asset or your company. How do you measure? For example, you have a house, how do you measure it? You measure it, the price you paid, or you want to use the current price. How much is the value now? Therefore, depending on which value you pick, the value of assets is different. That is what we see. Here's so there's a book value, market value, and so on. Book values is quite straightforward, how much they paid out at the times when you made the investment. Obviously, one you bought 10 years ago, 20 years ago, will be different to today's price. Today's price is the market value. Therefore, at least international recommendations, we propose that you have to evaluate the asset for investment in the market value. However, as you see here, still many countries use book value. One of the reasons is, particularly for many developed countries, difficult to value in the market prices. For example, foreign companies have one affiliate here operating in Bahrain. If it's listed in the stock market, then it's easy how much their value is at today's price. But not all the companies are listed. Then in this case, how they value? They might want to use average of the market prices on the stock exchange. There are several ways to evaluate the valuation of the prices, but depending on what kind of prices you use, you may also produce different numbers. And here's examples. You see that towards the end, at the end, you see example in the United States, FDI stock, depending on which value you use, book values or market value, while book value 3.2 trillion, but when it comes to market value, today's price is $5 trillion.
This is also true that today the market value of an organization is not measured by physical asset, by the intellectual asset. So here you have exactly the same thing. You see? So the intellectual asset of the corporation that determine what is really the market. So you transferred $3 trillion to the United States and you build a factory by Toyota, but that now worth $5 trillion. So if the American want to pay back, how much they will pay? The 3 trillion. That's
right, yes, thank you. Of course, when it comes to valuation, particularly invisible ones, the intellectual property ones, which he mentioned, probably very difficult to measure. While in the case of physical asset, more or less easy. But the truth, in the case of investment, this type of investment, invisible one, so intellectual property one, that's quite difficult to measure. So actually here, so we recommend use, two measures in market value. Same time, perhaps you still, if you have the book value, continue to also report in the back book value. Because particularly when it comes to country breakdown, quite difficult actually. So when you have investment abroad, it's not so much maybe from your country, but it's big from like UAE and so on. Then in this case, so if you want to calculate in market value, you have to look at the market prices in all different countries, and it's not so easy actually task. Now, next criteria is usefulness. Now you understand the comparability. At this moment, yes, it is true that there are some comparability problems. One of the reasons could be because of differences in the methodologies used by different countries. Now, usefulness, for any data, should be useful. And FDI flows, stock should be useful. But as you may have heard already, FDI flows not necessarily show how much they, for example, produced, or how much they employed, or how much they exported, and so on. FDI flows, in this case flows, we are looking at simply funds which transferred from parent companies to the affiliates. Therefore, and when you, as a company person, when you engage in production here, and suppose you are also affiliate of foreign companies, you use foreign funds which is given by parent companies as FDI, but you may also use other funds. You may want to borrow money from local banks, or sometimes even from the international markets. Therefore, when you look at FDI outflows here, you see the 3 years, 2009, 2010, 2011. This is for the US FDI outflows on the right column. And you see the first row, you have a list of host countries. And these countries essentially are in the MENA region. For example, Bahrain, 2009, FDI flows, which is reported by United States, minus 321, which is divestment. United States companies withdraw capitals from the Bahrain, or may have divested. Divestments only you learn later, even if you don't understand now, but simply you just consider capital withdrawals. But capital expenditures, if you look at, by United States companies here in Bahrain, even positive $4 million. It's not a negative. Why? Simply, US companies here could borrow money somewhere and spend as a capital expenditures. So anyone, I mean, all the, I mean, PLC in the financial sector is well developed. Therefore, companies may be easy to finance, to get loans from the local banks and so on. Therefore, FDI outflows do not necessarily same as capital expenditures by foreign companies. That is the, some things you have to understand. And for example, yes.
Outflows are basically capital expenditures are obtained domestically, or let's say, if a company from the States invested in Bahrain in 2009 and then decided to transfer more funds in 2013, would that be accounted for as more of an outflow or as a capital expenditure?
Normally, capital expenditures is amount of the investment which was undertaken that year. So therefore, of course, the companies may have used the fund which they could get the previous years, and they didn't spend until now, for example, and they start to use now. But the point is here, for example, 2000 or which year you take, actually, normally companies operate here not only use the funds from parent companies, which is influenced by the FDI, but also use other fund. That is the point over here. However, not necessarily because when you want to finance your whatever transactions, you may use your money, your own money here, or you may borrow money locally, local bank, or international bank also. You can even borrow money from the UK banks, for example. So it could be international or it could be national. No, they should, of course, they should appear. They should appear, yes, they should appear. But in this case, if they are foreign company operating here, which is foreign companies, not only is use the funds from the parent company, but also the loans from the international bank, like from the UK. These loans from the UK bank to your company is not recorded under the FDI, but recorded, yes, in the balance of payment. But also in the, the balance sheet of the company, that also should be reflected. Now, if you look at the Saudi Arabia, that's also quite an interesting case, because there's a big difference between FDI outflows and capital expenditures. This example shows, for example, let's pick up 2011, Saudi Arabia. United States FDI outflows to Saudi Arabia $800 million, while capital expenditures by US companies in Saudi Arabia report 342, which is less than half. It implies that US companies in Saudi Arabia did not use all their FDI flows from their parents. They may use only part of it. The remaining, I don't know how they used. They may not use anything, or they may have spent for speculative purposes, which we don't know, but at least not for the capital expenditures. For you, what is important? How much the companies invest, real investment, which leads to the production. Then obviously capital expenditures more important. But sometimes it is difficult for you to know how much foreign companies spend in capital expenditures. As a country as a whole, you can get, but for only foreign company, it's not possible. US has data, that's why we know it here. Okay? Another examples of whether FDI data is useful or not. And again, we are looking at the United States data. The reason why you have to use US data is because US data provides very detailed data. Now, we are looking at, on this chart, investment into the United States from, you have different countries, from Australia, China, Hong Kong, and so on. Here you see some GCC countries. You see Saudi Arabia, you see UAE. For each column, 2011, 2012, left columns, as you see, by immediate countries. Right columns by the ultimate beneficial owner, the country of ultimate beneficial owner. When you compile FDI data, normally you look at who invested in your country, immediate investor, so to speak. But these days, the company structure is so complicated. The companies which invested in your countries not necessarily ultimate parent. The company which invested here may have parent company somewhere. Therefore, when you look at who is really investors, ultimate real investors, then statistics may be different. Normal statistics is recorded according to who is the immediate countries. Therefore, in the case of the Saudi Arabia, because don't know the by immediate, okay. Let's look at the UAE, for example. UAE. Investment which comes from UAE in 2011, $2.5 billion, or $2,500 million. This is what we look at UAE as immediate investors. But if you look at UAE as ultimate investors, which means that UAE may have companies in Bahrain or companies anywhere, even tax havens, anywhere. If there was an investor abroad, what's happened? This is what we look at there by country of ultimate beneficial owner. If UAE in Bahrain, UAE companies in Bahrain, invest in the United States, then from the United States point of view, immediate country is Bahrain, but ultimate beneficial owner is UAE. You understand that this difference, what I'm talking about, they are by immediate countries and by country of ultimate beneficial owner. In fact, When you look at the UAE as ultimate beneficial owner, it's 10 times more. It implies that the UAE has so investment network somewhere. I don't know. So where they're located. It could be in offshore finance center, it could be tax havens, I don't know. But like Japan, for example, if you look at Japan, Japan is by far the largest investor in the States, nearly $300 billion. Looking at Japan as immediate, or looking at Japan as ultimate, almost same numbers, $300 billion. Which means that almost all investment from Japan comes from Japan, not necessarily through other countries. Therefore, here's, as long as you measure the FDIs by ultimate countries, sometimes you may have wrong conclusion that real investors may not be somebody, maybe somebody may not be. Here, unfortunately, we don't have a barren. So, what we recommend here, if you have, like in the States, two series of studies, one measured by immediate, the other measured by ultimate beneficial owner, that would be nice. That is recommended. So two series of the FDI statistics. Yes?
I don't quite get the table. So here it says inward FDI stock in the United States. And this is by the economies on the left column, right? So basically we're saying that Australia invested 48 million in the United States. But the figure of by country of ultimate beneficial owner, does that refer to the United States or does that refer to Australia?
I see. Now then, I can draw the, here is a border. We are looking at, for example, the Australia. Australia to United States. It's coming from here, from Australia to US, $48 billion. This I hope you understand? Yes. The one we are looking at, right columns, is we are looking at Australia as ultimate investors, which means Australia may invest somewhere, like Singapore, for example. And this also invest United States. This amount may be $7 billion. This amount, not only Singapore, any other countries. Here, we are looking at Australia as immediate investors. This is 48. Immediate as well as ultimate for this investment. But for this, immediate investor is Singapore, but ultimate investor is Australia actually. Australia owns Singapore, this company, and this investor here. If the amount is $7 billion, altogether, it should be 55. That's what you're looking at. It is clear now? This is offshore finance center, tax havens, for example. BVI, British Virgin Island, Cayman Islands, all these things in transit. Money goes there and they invest somewhere else. Therefore, so normally, when you, but here, look at Singapore. This is the opposite case. Opposite in the sense that when you look at Singapore's immediate $18 billion in 2011, but if you look at Singapore's as ultimate investors, $14 billion. What does it mean? It means foreign companies in Singapore invest abroad. Foreign companies in Singapore, not Singaporean companies owned by somebody else. Therefore, if you want to promote investment on a particular company or a particular country, you have to know, for example, how much they really invest. They may invest using tax havens and come here, for example. That is why actually we recommend you to look at both statistics and recommend you to collect both statistics. Okay. This one. Let me skip these ones. Okay. Now, FDI flows. We are talking about normally in advance payment. And the rule, the FDI flows in advance payment, actually FDI flows should be on a net flow basis. Net flow in the sense that we have to take into account, as I mentioned, number of divestment, for example. You may look at, of course, the new investment from the United States here coming, all new investment. But at the same time, same companies may return the capital back home, back to the United States. Or if it loans, they may give back loans to the parent companies. Always, we have to look at both transactions, from parents to affiliates and from affiliates to the parents. That's what they call the net. Then, sometimes, because the FDI flows in the BOP which we look at, because of this particular nature, sometimes it may give the confusion. Confusion in a sense that, okay, this is the case of Japanese outflows. Like 2013, Japanese FDI outflows, $135 billion. This is what you see in their balance payment, $135 billion. But this is on net basis. If they are not netted out, if divestment is not taken into account, it's kind of gross investment, all kind of new investment coming in, then it's more than $240 billion. For you, sometimes you want to see how much new investment coming into the country, not necessarily net basis, because net basis includes divestment. Divestment takes place even if so there's nothing wrong with their countries, but it's decided by parents company. If parents company want to withdraw the capital from their countries, they do so, even though there's nothing wrong with the host countries. So therefore, sometimes the net-based FDI flows gives sometimes misunderstanding in the numbers. Particularly, this is important for you when you analyze data. FDIs on a gross basis and FDI on a net basis is a big difference. Now, another question on usefulness. Still usefulness continues. What do you see in the global FDI flows, like $1.5 trillion, 2013? It may contain double counting. Double counting in the sense that, for example, so this case, the one that's on the chart, Australia to United States, 48. This is recorded. And from Singapore to United States, 7 billion recorded. And from Australia to Singapore, 7 billion recorded. Then all these three things counted in global level. Then obviously this amount is double counting. This is what you see transshipped FDI. FDI, that is channeled by direct investors to special purpose entities. Here we are looking at, normally, this kind of transactions take place through special purpose entities, SPEs, and invested in other countries. This is a transshipped FDI. The other case for the double counting, we also what we call round-tripped FDI. Round-tripped, leaving the countries but coming back. Particularly like between Hong Kong and China, for example. FDI that is channeled by investors to SPEs abroad and subsequently return to the home country. Why they are doing this? Because foreign investment is given sometimes special incentives, which is not given to domestic investment. Therefore, in order to qualify such incentives, investment may be sent, the funds sent abroad, and such funds come back to the country. What you see is, interestingly, if you look at the investment into like a British Virgin Island or Cayman Islands, and if you look at if the inflows to those economies and if the outflows from these economies, it's almost same. So therefore, the time they keep in offshore finance centers abroad may be short. But it doesn't mean that always short. It may kept several years. But basically, normally the reason why they do is simply tax avoidance. So, so once they clears of the tax payment, I mean, not to pay, then they may spend immediately, which I don't know, maybe, or they may continue to stay. So the holdings in special purpose entities abroad or like offshore finance centers, quite difficult to determine how long. But perhaps I tend to think relatively short, given the fact inflows, outflows, to or offshore or offshore finance center are the same. Now this is the land tripping case. Okay, this is the case of between Hong Kong and the BVI. As I mentioned, like from the Hong Kong to BVI, $35 billion, coming back about $25 billion. It's a bit of differences. And this is a case of the transshipped investment. Typical case is Luxembourg. If we include investment in SPEs, special purpose vehicles, normally it's an investment which goes through the SPEs, leave the countries, $435 billion, but the real investment is only $24 billion. Same things outflows. Outflows, $410 billion from SPE, almost same amount in inflows to SPE, which also leaves as outflows from SPE, $410 billion. Now, investment in offshore finance centers or investment in SPE, special purpose entities, are included in FDI flows statistics or stock statistics. As we know, the question is whether it is meaningful to include such investment. Because SPEs, or offshore finance centers, normally there's no economic activities, but still includes amount of investment which go there. Therefore, what we recommend is that you have to specify how much goes to SPE and how much coming from SPE, in addition to FDI, like normal FDI flows, inflows, outflows, and you have to give supplementary information into and from the SPEs. That is the recommendations from international organizations. And this is definition of the SPEs, which we learn later again. Oops. FDI data, I moved to the different other criteria. Data should be reliable. If FDI flow status are compiled in the advance payment and based on the advance payment basis, and obviously data should cover all kinds of economic activities, and all the required components of FDI, which will come back in the concept discussion of FDI. There are three components: equity, reinvested earnings, and other capital. There are three components. Under the stock, you have equity and other capital. These are components which comprise flows or stock, and for each component you should have the numbers.
rest of the FDIs, what happened to the rest of the FDIs that don't meet the threshold of 10%? Where do they go? They don't appear at all and because that doesn't capture the value, as the gentleman said here, there maybe you could have one investment that meet the threshold of 10% worth 1 million, another one doesn't meet the threshold. It could be below 10%, but it could be more than $1 billion. What happened to that?
Actually, all international transactions should be recorded in balance of payment. Therefore, the one you mentioned should be recorded. Where, actually, as I mentioned to you, there are 3 components under the capital account of the balance of payment. One is FDI account, which we are talking about. Yes, then the second one is a portfolio, investment portfolio, which is less than 10%, like 5%, 3%. The third one is other capital, which is like bank loans, essentially. So therefore, anywhere in the transaction you mentioned should be included. It depends on what the transaction you're referring to, but supposed to be, not supposed, should be included anywhere, somewhere in the balance of payment, if it is international. So, but not in the FDI, not in the FDI, right. Now, of course, the data should be on international standards. And here, some countries report actual means BOP-based, balance payment-based data, approval. Many countries continue to report approval investment. Investment is approved by specific agency, like an investment promotion agency, for their own purposes. Therefore, normally it's actual investment and approval based in FDI is different. This is an example for 3 countries. And now, here's the examples of the countries which do not report a specific component of FDI. I repeat, there are 3 components under FDI flows: equity, reinvest earnings, and other capital. Equity, reinvested the earnings, other capital. There are still some countries which do not record one or more the elements of the FDI. But do you understand the equity investment, reinvest the earnings and the other capital in their FDI? Yeah? We are talking about the FDI. Reinvest the earnings is reinvestment by foreign companies. Foreign companies generate the profit, and they may reinvest, they may use the profits to make the investment. That is the investment. That is what we call the invest earnings. Other capital is not equity, but other types of the capital from parent companies to affiliates. When, for example, parent company give loans to you, then it's also included on the FDI flows. But loans are loans. Affiliates should return the loans back home to the parents. Therefore, when foreign companies return the funds, return loans back home, back to the parent company, then it is recorded as repayment of loans, and this portion is deducted from FDI flows. You remember I mentioned divestment. This is included the negative investment. These things again, we learn in details later. But here just I mentioned as an introduction. Now, here, also, I'm not 100% sure whether it is correct or not. Like Bahrain, FDI flows cover only the finance sector. That is true. That's true. Okay. That is why we see only $1 billion investment. And obviously, then data should include other economic activities. Therefore, so, your numbers are underestimated. Egypt, in the petroleum sector, only to be started to include in 2014, for example, or 2004. China, they start to include the finance sector only from 2005 onwards. Simply because that year China opened up the financial market to their foreign investment. That is why so they also could start to include the finance sector. This is an example of the countries which may not cover all economic activities. Now, we move to the next criteria, which is data should be comprehensive. Comprehensiveness in FDI flows stock data, perhaps whether you produced.
And here you mentioned that it's part from 2004. From the table here, it shows that it's not included as a part of what. And here, it's included here. There is already. Yeah, names.
Okay.
And in page 16, I mean in page 8.
Then that should be not updated.
Yes.
Good point. Yeah. Thank you. You have very good eyes. Thank you very much. Thank you. You understood her point? No, so she mentioned here, Indonesia, we mentioned the invest earnings start to be included. And here, in this table, equity, under the reinvest earnings, we mentioned Indonesia, which is not such a case. Therefore, this table should be updated. Yeah, that's it. Yes. Now, comprehensive data is required for policymakers, not policymakers, whoever want to use data by country breakdowns or by industry breakdown, for example. Here, we have examples. How many countries are doing this? We have FDI, inward FDI, inward flows by countries' industries, outward flows by country breakdown, industry breakdown, inward stock by country breakdown, by industry breakdown, outward stock by country breakdown, industry breakdown, and so on. For FDI flows by country breakdown, is 133 economies in the world have such information. But when it comes to outward stock by the industry breakdown with only 60 countries. Therefore, still not all the countries report FDI in a comprehensive manner. The other element under the comprehensiveness is FDI's data we should report is a fully consolidated basis. For any companies, there is its own structure. It's not single companies which may operate here. That companies may have other companies. Therefore, any companies may form a chain of the companies. Then in this case, actually to what extent we are looking at. For example, here's Bahrain. You have companies here, company X, but this company owned by abroad company A, for example. But these companies may have Y and Z, the other companies. Company X may have established in Bahrain Y and Z, for example. Then, if there is investment from here, this A is the parent companies, like for the United States, for example. From A to Y or A to Z, for example. From A to X, this is quite clear. It should be FDI if it's more than 10%, yeah? More than 10%. Then anything between A and X, any transaction, if A gives loans, for example, like $10 million, then this loan should be recorded under the FDI. But what happened here, for example, Y or Z? If there's loans from the company, parent company A to Z, again, $10 million loans, for example. What do we do? In this case, we are looking at this structure of the companies by actually several methods here. That you see the US method. As long as this parent companies owns more than 10%, any of these, then it should be included. How they calculate? Let's consider, for example, here 50%. A owns X% 50%. 50% owned by A. Then, suppose this X owns Y, like 50%, for example. And this case 10%, for example. X owns Z 10%. Then you can easily calculate how much A owns Y or Z indirectly. How much in this case? A owns Y, how much they own? 25, yes, 25%. 50 times the 50. This case, 50 times 10, right, 5%. It is less than 10% in this case. This is more than 10%. Therefore, this is supposed to be included, but this is not. That is what we call the US method. The other case, you see the EU method. Here, EU method looking at voting shares. Voting shares. As long as immediate owners has more than 50%, it should be included. Therefore, for example, here, let's consider another case. maybe company B here. Let's see. How much do we say that? Okay, 20%. No, it's not good. Again, let's consider the 50%, for example. 50%. You see the X owns B 50%. This is the majority. This is already FDI relationship, that's fine. Then between X and Y, it's majority 50%, more than 50%. The Y is included. Z less than 50, not included. This one, again 50% included. But for example, not the 50, 40%, for example. Then this is less than majority. Therefore, B is not included under the EU method. But the US method, 50 times 40 is 20%. Therefore, under the US method is included. EU method is not. It's a bit confusing depending on the methodology used. Therefore, actually, we have new, actually, how do you call the FDIR, new method. It's a framework of direct investment relationship. Sorry, yes. Sorry, perhaps you can see them. 40%. B 40. So X owns B 40%. I mentioned, so 40 less than majority. Therefore, under the EU, not included, but under the US, 50 times 40 is 20%. Therefore, under the US is included. But now, it's hybrid method, which is FDIR. You learn it later when you introduce the concept of the investment. But here, what do we see? We see the change of the relationship of the companies. And as long as, if you look at all these kind of chains, again we have here, again we have here, again we have here, and so on.
Y and Z and B are included outside Bahrain. They are not within the territory of Bahrain.
Sorry, at this moment we are talking about the Bahrain. Yeah. Okay, everything is Bahrain.
But as to my knowledge, that the principle of residency is here applies.
Whether they are established abroad. Yeah. Okay, his question is whether they are established abroad, how they do this. Not necessarily Bahrain, maybe Saudi Arabia or Oman and so on. Actually, in this case, we learned later, so we have another categories of the companies, which is called fellow enterprises. Fellow enterprises. Fellow enterprises, are those which have common parent companies. For example, company A in the United States, put like this, for example, owns company B in Bahrain, also company C in Oman, for example. In this case, A owns 50%, A owns C 30%, for example. In this case, both companies B and C have a common parent company, which may be US. In this case, what you are concerned about, if there is investment or from A to B or A to C, then obviously it's recorded in each country. That's for clear. But if C to gives, for example, loans, $10 million from C to B, in this case, actually, we assume that A is the parent companies, and we have an investment from their own lands, but ultimately owned by company A in the United States. In this investment, since within the same family, and the common parent company, then we assume that the investment comes from A.
Suppose the company B owns another one in Bahrain. Or K. Any transaction between these two are not included.
Here between this and B and K. Like for example, B gives loans to K, like $10 million. In this case, this 10, it's of course, if 10 doesn't come from here and locally secured, locally raised,
B goes to the
no.
national bank in Bahrain, obtains the loan, and gives it back to K. Suppose that B, the company, goes to a national bank here in Bahrain, obtains the loan, and gives it back to K. So would this transaction be included in the FDI?
B, you said the national bank or any development bank, which get loans from somewhere in United States. It could be anyone. But in this case, this national bank and A, what is the relationship? That's what we have to determine. If this one is affiliate of A or foreign company of A, then yes, so we have to consider this is a foreign affiliate of A, and anything between A and B should be considered. But there is no relationship between A and this national bank.
Even though the transaction is recorded under the name of company B, it's not with the affiliate, with the parent company.
Actually, he meant B is the affiliate of company A, but there is a national bank here which got loans, which gives loans to company B. That's what you are talking about, I guess. But these loans, your question was FDI or not?
Yes, this is the first one. Is it an FDI transaction?
Between this national bank and the B. No, it's not FDI transaction at all, because it is simply the loans raised by company B in Bahrain. And unless there is any relationship between this company A and this national bank, if there is already a relationship here, it's different. If this national bank owned by company A, and in this case, this national bank and the B have a common parent, therefore loans from national bank to B, it's different because this national bank and the B is within the same family. Okay, so company B gets loans from national bank and they give it to K. But these loans from B to K, like $10 million, where do they get these loans? From national bank. But this national bank, A different, no, because so this national bank, if it's owned by company A, it's different, but it's not owned by this company. It's independently operated here. This national bank exists. Then we consider this is just the usual banking transaction. Therefore, company B borrows money from this national bank and lends to company K. It is a purely domestic transactions, yes. No, nothing. It's not. Because in the FDI should cross the border, actually. Cross the border. In this case, it doesn't cross border.
Y and K and B, would you just return back to the first paper? The first paper, yeah. Yes. That's why I'm asking that companies Y, Z, and B are within Bahrain. Yes. Was any transaction between them?
Yes, yes. Because in this case, we have a common, all of them, common parents here, and the ultimate owners, the A. But in this case, there's no common parents. Oh, sorry, the parent of the national bank is nowhere, it's on. Because there's no relationship between A and national bank. This bank exists independently, independent of company B, independent of company A in the United States. I think you learn later in details all these things, but let me. Oh yes, we have to stop this FDIR. Actually, so this is I mentioned the hybrid, the method, and to what extent the structures is included in the calculations all depends, the ownerships of these chains. For example, I continue to use this example 50%, 25%, 10%, this is a 40, this is a 40, and consider this is 30%, or again like 60%, for example. Now, the FDIR, we look at each chain to see how much the immediate owners own. For example, here, A owns X 50%, X owns Y 50, Y owns, let me see, it's like a C and a D and E. Y owns C 25%, D owns D 30%, D owns E 60%, and here X owns B 40%. That is this kind of structure. We look at each ownership, and FDIRs look at majority, and when it comes to minority share, as long as in this chain, in different chains, as long as majority owned continues, fine. But if minority owned, like less than 50% included, you can include only once. Therefore, 50% owned, Y 50% owned by X, therefore yes, it can be included. I don't have different, maybe. 50%, therefore yes. This one, 25%, it's a minority, but in this chain, this only once we appear. So this yes. Here, 50%, owned by A, but this company, A, X owns 10%, only once, yes. This one includes 50%, 50%. It's majority, therefore fine. 30%. We said, sorry. This is 30%. Therefore, we have to stop here. We can't include more because the minority appears already once, cannot appear twice. Therefore, this one, and this one. Here, 40%. This line changed only once, 40%. Therefore, this can be included under the FDI hard. But you learn it later. I know it's a bit complicated because there are 3 different methodologies are introduced. But the result is no matter which one you use, actually the result almost the same. And this is, of course, ideal ways to calculate, but also I'm not sure to what extent, the country which already collect FDI, to what extent they'll consider this, consolidated consolidation of the companies. So we're moving to. Now we have the very end. The last criteria is timeliness. Any data should be out the sooner. The sooner the better. If it becomes so late, it's not so much useful. And this is examples for us when we compile the data for the World Investment Report. We receive data mid-May, for example. Most of the countries, they can report the data for the previous year. For example, the report you're looking at, 2014 WIR, I think it's not 2014, but mid-May 2013, but mid-May 2014. Yeah, mid-May 2014. We normally say by mid, 160 out of the 200 economists report. But when it comes to talk, about half of the country could report. Normally, within 5 to 6 months, the data should be ready for their flows. Okay, now as I mentioned to you, there are different criteria to judge the, whether FDIs is good or high quality. Still, even the advanced countries which compile FDI, still a lot of the problems. Therefore, since you start now, and I know all of you face similar problems, but it is not so late at all. So once you understand the concept, then you can collect the data. Okay, so thank you very much. Any questions on this? Yes.
The quality of data. We didn't speak about the sources. It should be through surveys, or it should be through,
Later on, actually, we introduce a survey, and the survey, I think, is the best way still. Of course, you can capture part of FDI through other means. For example, through the central bank. For example, when the central bank collects all records of the buying and selling of foreign exchanges, for example, then they may capture the investment transactions. But they can capture only part of it because FDI flows, for example, have 3 components. Don't forget 3 components. Not just equity, but also the investor earnings, The investor earnings you can capture from the banking records at all. You have to ask the companies, or you have to get data from the company on your reports on the phone. And the other capital, so the banking transaction, which called international transaction reporting system, you may be able to capture only part of it. So therefore, and also you have heard the different several recommendations. For example, you have to also report investment to and from special purpose entities, and also the investment which is recorded based on immediate investors or ultimate beneficial owner, also different. All these things can be possible, can be done only through the survey. You can't get it from anywhere else. So therefore, our recommendation is to use the survey. If you have the survey, and if you can capture all these things, then the thing is how you modify the existing survey. His question, how we can trust the data, was how do you trust data to the ones reported by companies? And to me, of course, we also have sometimes this kind of problem when we receive data from the countries. Sometimes we see very funny numbers. Then we also come back to the country, it must be wrong. Then sometimes the people who fill in the form and they give us back, sometimes also they make mistakes, actually. Inflows, outflows, they changed, and also it happens. And therefore, of course, when you see dubious numbers, you have to always go back to the companies, in this case, to ask. That's also required verification.
Why don't we ask for the statement for the companies? I know it's going to be a long processing time, but it's going to give me good quality data. Survey, even the percentage of the company that fill out the survey usually very low. This is the problem that we are facing.
Actually, this is something also we are going to learn how we can increase response rate and so on. But in some countries, like in the United States, everybody is mandated to fill in, otherwise they're punished. It's not just a fine. So paying a fine is easy. It doesn't cost much. But if they are prison, it's different things. So it's crime. It's not necessarily, for them not filling the survey, it's same as crimes. And therefore they're punished, not just paying the fine. It's more than this. So in some countries, quite strongly, it's mandated. And I don't know, in your region, how strong you could be. Of course, this is always a dilemma for any survey maker, surveys people, to increase the response rate. And obviously, to get a higher response rate, you have a good relationship with companies. If you have a good relationship, also the response rate is different. And the more important is if the companies understand the meaning of the survey, then it's also different. And if they're convinced that your responses affect the policies affect their operations, then perhaps this is the way you may convince. I know in the countries where you cannot even find the companies who are not cooperative, then apart from the ways you can persuasion. It takes times and you have to approach it persistently, otherwise the companies may not respond easily. So at this moment we recommend the survey, but we come back later again. So any other questions? Well, I think it's both in the sense that FDI flows, it goes straight to the advance of payment, but other kind of data like a stock is different. And also we are looking at only part of the FDI statistic, namely flows and stock. Later on, we also learn the activities data, like impact data, like sales or assets. And so they are related to the company's balance sheet, more or less, which is different from advance or payment data.
Financial statement in this case, data you can get it directly from the survey, directly the contact with the companies. But if we are talking about a foreign direct investment within balance of payment, in this case a survey, to whom you will send it?
Well, so this is something we are going to launch tomorrow, and what kind of survey we can use. And actually, so what the other countries do is normally collect data through the survey, actually. And this is what we are going to learn, and what kind of survey we can use. Yes, you can get all the kind of the data so we are talking about, flows and the stock and activities of foreign affiliates in one survey. So first of all, you have to see the corporate ownership. I mean, we know, for example, this company is a foreign company, but if we don't know how much the foreign owns you, I can't calculate easily FDI. Like, so I know that you are one of the foreign companies, but how much the foreign companies own you? 10%, 50%, or fully owned? It depends on ownership. And if the ownership is different, the calculation is also different. So that's why, so normally it's not so easy. So the, so final statement available. So we have to normally ask the company. Okay? All right.
Thank you very much. Now, I got a suggestion from the colleagues of MENA Center that we have to vacate the room at 5:30. There is another activity. So we are going to continue tomorrow with the presentations. I hope that today we had quite enough information in order to be familiar with the topic, with FDI and FDI issues. And tomorrow we will begin first with FDI as a part of balance of payments. Then we will discuss about the main players of foreign direct investment. So what is the direct investor, what is direct investment enterprise, and what is fellow enterprise and their relationship. And then we'll speak about FDI flows, stocks, and FDI income. We'll touch upon the question that the colleague from Saudi Arabia mentioned about the different types of collection, either using, I see, the interbank transactions or surveys or other administrative issues. So for today, this was the first day, and I hope that you at least get a flavor of what we are going to discuss for tomorrow and after tomorrow. Thank you very much. Tomorrow at 9, I think this is the program. So at 9 we will begin, and let's be sharp in order to catch up a bit the timetable. Thank you.
Dear Mr. Fujita, thank you very much. Mr. Astrid, thank you very much. And dear guests, we hope have a nice evening, and we see you tomorrow at 9 o'clock. Thank you very much.